Welcome back to part 2 of pricing. Now that we've mastered the key idea of pricing, it's time to level up. In part 1, we priced items based on food and labor costs alone, and that's a good start. But in the real world, there's usually more things happening behind the curtain. So let's try to pull it back and start with hidden costs, also known as invisible costs. They're the silent expenses that don't show up in your ingredient list or on your paycheck, but chip away at your bottom line all the same. Because prepping a dish takes time. Measuring portions means some food goes to waste. Cooking errors, spills, service mistakes, it's all part of business, and it's all costing you money. We can't predict every ounce of loss, so instead we estimate it. Industry standards say to use a 10% buffer to shield against this everyday chaos of running a kitchen. So let's revisit the markup process again to see how this works. In this problem, we're told that we have raw food cost for an item, $1.25, and a food cost percentage of 35%. It asks what the selling price should be if we factor in hidden costs. Well, the good thing is the equations haven't changed at all. We're just going to factor in this additional 10% on top of it. So do you remember how to solve for selling price? Selling price is equal to the cost of goods sold multiplied by the markup factor. And the markup factor is equal to 100 over the cost percentage. We know the cost percentage is 35% here. So we have a markup value of 2.86. That 2.86 is our markup factor. And so since the problem gives us the cost as $1.25, we can figure out that the selling price should be $3.57. But this does not account for hidden costs. To think about hidden costs, we want to factor in an additional 10%. And as always with percents, there's a few ways to think about it. I personally like to think about an additional 10% to be 1.10 or 110%. If you take your total cost and multiply it by 1.10, which is 110%, 110% is 1.10, will give you the selling price of $3.93, factoring in these hidden costs. Or you can say, all right, well, the price without the hidden costs is $3.57. 10% more, let's take 10% of $3.57. That's 36 cents. Add it to the initial, which is the remaining 100%, to get $3.93. Either way, your selling price is $3.93 when you factor in 10% for hidden costs. Now let's move from the hidden to the constant by reviewing fixed costs. As we said in the last video, fixed costs are the part of your operation that don't change, regardless if your business is booming or dwindling. Rent, utility, insurance, these costs are always there regardless of your profit. Variable costs and semi-variable costs are part of cost of goods sold, COGS. Remember from the last video, fixed costs are not part of cost of goods sold. You don't include them in COGS because they don't scale with the item. But when fixed costs are provided in a problem, you can use them to help you set your selling price. Your goal is to make sure that the profit that you build into the price is enough to cover these fixed costs. As a review, variable costs change when your production changes. The more meals you serve, the more chicken you buy, the more customers you handle, the more napkins that get used. These are all variable. Semi-variable costs live somewhere in between. Labor is a good example because you pay staff a base wage even if no one walks through the door. But if things get busy, then overtime can kick in. And overtime is a semi-variable cost. That's why variable and semi-variable costs factor into the cost of goods sold because they scale as you sell more items. In more complex selling price problems, we need to factor in the total percentages: food, labor, fixed costs, and even profit. And all of them together will shape that markup factor. So before we do a more complex practice problem, let's make sure we understand the difference. There's two ways that you'll see pricing show up in problems on your RD exam, and the difference comes down to just one key question. Do you already have a cost percentage, or do you need to find the cost percentage? So let's start with the first and most direct kind of problems, the ones we looked at in the last video. We're calling this the food cost percentage method. You'll use this method when the problem gives you a cost percentage upfront. This percentage represents how much of the selling price is being used to cover your costs. And while the cost percentage is usually just food cost percentage, sometimes the problem will have you add in both the food and labor cost percentages if labor is being factored in as part of the selling price. But if both food and labor cost percentages are given, then that means they're both part of your total cost. They both scale with production, and so they'll both belong in your cost percentage. But the other type of problem is the one that we are primarily looking at in this video, and we're calling this the cost breakdown method. We use this method when a problem is giving you pieces like profit, labor, and fixed costs. Remember, fixed costs are not part of cost of goods sold. These problems will not give you the food cost percentage. In problems like these, you're missing the key part of the picture. So you'll start with 100%, which is representing the full selling price, and subtract everything you already know. Subtract out the profit, the labor, the fixed costs, and whatever's left over is going to be the percentage available for food. That remaining percentage becomes your cost percentage, which you'll then use to calculate your markup factor. So the calculations in both of these problems end up being the same. The markup factor is 100 over the cost percentage, and then the selling price is the cost of goods sold multiplied by the markup factor. So the question is, when do you use each one? If you are outright given the cost percentages, then you'll use that to find your markup factor. But if you aren't given the cost percentage, specifically the food cost percentage, then you'll subtract all of the known percentages from 100% to figure out the food cost percentage. Once you have your cost percentage, you'll calculate your markup factor by taking 100 over that cost percentage, and then using that markup factor multiplied by your cost of goods sold to get your selling price. So let's try one, a cost breakdown method, where we aren't outright given our cost percentages. Let's say that in a small cafe, the manager wants profit of 7%. From the accounting, the manager knows that fixed costs account for 20% and labor costs are 32%. If the cost of producing the coffee is 65 cents, how much should it be priced for? So in a problem like this, a pricing question, we're still using those same two equations. First finding the markup factor, then solving for the selling price. And we're told the cost of producing the coffee is 65 cents. That's not just the food cost alone. That 65 cents is already including everything it takes to make the coffee. The ingredients, the labor to prepare it, and the share of fixed costs like, say, rent or electricity. So this 65 cents is the total cost of goods sold, or COGS. It's the full input cost before profit is added. So when we're calculating the markup factor, we're asking what percent of the final price does this 65 cents represent? Once we know that, we can scale it up to get the full selling price, including the desired profit. So to calculate our markup factor, we need to know what percentage of the final price that 65 cents represents. And to do that, we subtract the known percentages, the profit, the fixed, and the labor from 100%. 100% is the starting point. Subtract out 7% for profit, 20% for fixed costs, and 30% for labor costs, leaves us food costing 41%. This means the 65 cents is expected to represent 41% of the selling price. And so with that, we can solve. We'll take 100 and divide it by our food cost percentage to get a markup factor of 2.44. Next, we multiply our markup factor by the cost of goods sold, 65 cents, to determine our selling price of $1.58. So that's your answer. The coffee should be priced at $1.58 to cover all costs and hit the desired profit. This approach lets us reverse engineer the selling price from a cost that already includes multiple components. It's a great real-world skill and one that shows up on the RD exam. So remember the process. Think of the total cost as percentage, subtract out the known margins, use what's left to build your markup factor and to scale the cost up to price. And that is how you go from cost to selling price with both clarity and confidence.